All right, guys, welcome back to the tax strategies of the rich and famous. I'm excited to kick this course off here with you today. We're going to start getting into some nitty-gritty details of some important things to keep in mind as you're going through this course. And we're going to start by identifying the different types of income that you're going to have throughout your life. And the reason this is important because we're going to be talking about a lot of, well, mainly two types of income that we'll go over here today that really determine whether or not you can actually take losses against your active W-2 income. Okay, so we always start by discussing the four main types of income that you are going to see that comes through your tax return. Okay, the first one is your earned income. Okay, your second one is your ordinary income. Your third one is passive income. Your fourth one is capital gains and losses. Now, if we were to separate these into four little columns here, we're going to talk about the different types of incomes that flow into each one of these four categories. Okay, our earned income is typically your W-2 jobs and then self-employment income. And now this income is usually subject to an extra 15 to 16% tax. Okay, now what those taxes are, they're typically the additional payroll taxes that you have to pay when you're either a W-2 employee or a self-employed individual. Now, when you're a W-2 employee, we go through this in a different video here, but as a W-2 employee, you only pay 7.5% of those payroll taxes, and your employer matches that and pays a full 15 to 16% into the government on an annual basis, right? Or however frequently they have to pay it. When you're self-employed, you have to pay both halves of that, right? Because you own your job. And so your net income in that activity forces you to actually pay both sides of that on your tax return. You pay that through the Schedule C, you pay the extra 15 to 16% tax, which is brutal, okay? Your ordinary income is your pass-through income, and then other income that's not typically associated with earned income, right? So like additional like unemployment income and stuff like that would just fall into this general ordinary income bucket, okay? This is subject to your ordinary income tax rules, and this pass-through stuff would be like your S-corp pass-through, your partnership income that's pass-through, that's not subject to additional self-employment taxes. Usually partnership income is subject to extra taxes depending on how it's taxed, okay? But that's typically what comes through the ordinary income side. Your passive income is your rents, royalties, your dividends, any passive business investments. So those types of activities that are passive, meaning you do not materially participate in them, are passive activities, okay? Capital gains is the sale of capital assets. The most important thing to remember within this discussion is the IRS puts these big barriers between passive income and losses and capital gains and capital losses. Okay, on our tax return, if you have a capital loss, you cannot take that capital loss against your ordinary or your earned income. Same thing with passive, right? Your losses can only offset passive income. Same thing with capital losses. Your losses can only offset capital gains. Okay, you're limited very severely on what you can take from a loss standpoint within the passive income bucket and the capital loss bucket. So our ultimate goal with everything that we do around tax strategy is figuring out a way to either take our earned and ordinary income and shift it either into our passive income buckets or our capital gains buckets, or to do the opposite, right? How can we take our passive income or our capital gains and shift those over into either our earned income or active income or ordinary income bucket to then be able to take those losses against our other income so that we're not limited on what losses that we can take on a regular, ongoing annual basis, okay? So this in a nutshell is very important to understand the different types of income. Now, as we go throughout our four different sections of the course here, we're gonna talk about the different ways that our investments like real estate and oil and gas and these small business investments in stocks, how they fit into each one of these categories and what that looks like from a loss standpoint and how we can take those losses against your regular W-2 income or your other business activity. I'm going to leave it here and we're going to jump over and talk about specifically real estate. Thanks, guys.